I just want to welcome everyone to the Greater Central Florida Multifamily Investors Group meeting, where we focus on investing where it makes sense. That's sometimes easy to say, hard to do, but we do our best to focus on those things. I'm your host, Ismael Reyes, and the goal of this group is to learn from and help each other do multifamily deals with a focus on Central Florida assets or potential investment partners in the area. Joint ventures and syndications are two of the main ways that multifamily investors can get into deals. Simply put, a joint venture or a JV, as some have heard it called, in real estate is when two or more investors combine their resources for an investment. Despite collaboration, each party maintains its business entity while, and here's the key, actively working together on the deal. Syndications are a type of security offering. In a syndication, a sponsor or managing team is actively responsible for the overall success of the project, but those that contribute capital and are not on a sponsor team are considered passive investors. So let me go ahead and formally introduce Matt at this point. Matt has a Bachelor of Automotive Engineering degree from the University of Swansea, UK. He is the sole founder of Right Move Properties and an apartment syndicator whose company owns 118 multifamily units within South and Central Florida, Eastern Tennessee, and Southern Alabama. Over the past 4 years, his company, Right Move Property, has acquired 12.9 million assets. This has been accomplished by utilizing value-add strategies. We talk about those a lot here. Those are really good. He capitalizes on his analytical skills and attention to detail. And then by doing so, he's able to close investment opportunities by being competitive and operating with integrity while achieving strong returns for investors. Integrity, I can't say that enough. Integrity is key in this business. Matt also has a good number of multifamily joint ventures, which makes him unique and qualified to speak today on this topic. I've known Matt for several years now. We were actually co-GPs in a Tampa asset that recently sold, so that was good. And we're ready to co-GP on something else, my man. But at this point, I'll leave it up to you. The floor is yours.
Well, I appreciate it, Ray. Thank you so much for having me. I'm just going to go ahead and share my screen here. If actually, if you could activate that, I'll get that going. But yeah, it's an honor to be here tonight. Like I said, I've known Ray for a number of years, since I think 2018. So yeah, it's a pleasure. So let me just make sure that everyone can see this. Is everyone able to see my screen okay? Perfect.
Yes.
Okay. So yeah, I'm going to be talking
Matt,
about.
You want the questions to just be put on the chat, right? And that way I can read them off to you. Is that best?
Yeah, that'd be great. Yeah,
okay.
I appreciate it. Thank you. Yeah, so I'm going to be talking about the pros and cons from my perspective of joint ventures versus syndication. So I've been investing in multifamily since 2017. I'm going to kind of give you a little overview of my portfolio here in a second, but this is basically what you heard from Ray already. So yeah, I'm really into cars. That's kind of my second passion. Motorcycles, travel as well. But yeah, I'm part of Jake and Gino. That's my family there. Our girls are 4 and 6 now. And yeah, just a couple plugs here on some media that I've been on. So some good friends of mine run Tech Guys Who Invest here in Tampa. So I was interviewed by them last year. And a good friend of mine does a collecting real estate podcast, who's part of Jake and Gino as well. And I was really honored to be interviewed by Movers and Shakers from Gino himself in December. So that's my most recent podcast. So yeah, they're always fun to be on, kind of gets me out of my comfort zone a little bit. I want to kind of talk about a little about my criteria. So what I look for, I think that might allow you to kind of understand why maybe more of the deals I'm doing are JV. So I focus predominantly on B to C class multifamily assets. So over 5 units, ideally in B locations. I will consider C plus locations. And I have my predominant market is Southwest Florida and East Tennessee. I have 118 doors that I've owned. 18 of those are actually my own deals. So I have all my own equity in those. My returns I look for, well, I used to look for about a 10% cash on cash when I started. Now that's gradually dwindled down to around 7. So deals are getting tighter, and about mid-teens, high teens on average annual IRR. And I underwrite to a 5-year hold. That doesn't mean to say I'm going to always do a 5-year hold, but just to keep it consistent in my underwriting, I always will use 5 years. So it's a fair comparison. And honestly, I look for a pretty wide range of deals between 20 and 120 units. So I have, this is the list of properties I currently have. I closed this 4-unit here in Clearwater in 2017 with all my own money. Actually cleared out a HELOC from our primary to fund it. Did a 3-unit in Winter Haven, which is close to Lakeland, same year. And I actually invested in a couple short-term rental cabins in Sevierville, Tennessee, near Pigeon Forge, Gatlinburg. That was in 2019. Again, all with my own money. This was my first syndication here, a 59-unit. That was also in 2019. I had 3.6% equity in that, and I'm going to actually cover off these next 4 properties in a bit more detail throughout the presentation. And as Ray mentioned, we sold that last month. So that was, and I'll also cover off, how that kind of looked for me as a GP, which I think had we not have sold that, I probably wouldn't have been able to give you as a good a comparison of syndications versus JVs, because now I've done full cycle. I did an 8-unit in Fort Myers in September last year, 90% equity in that, mainly because I have a construction partner down there in Naples, who basically is, he's incentivized actually at 10% on the GP side. And then once he fulfills all of his obligations in the operating agreement as per the scope of work, and we get to our target business plan result, then I'm actually incentivizing him to additional 20, up to 20. So that'll be 80-20 at the end. So something creative you can do with a JV that you wouldn't be able to do in a typical syndication. I did a 16-unit in Gainesville last December. That was actually a TIC, so a tenant in common. I'll cover that a little bit more as well when I talk about the deal. 4 GPs in that one. Same month, we did a 24-unit in Saraland, 7% there. That was 5 GPs. And then we're actually in contract right now in East Tennessee in Seymour, just south of Knoxville, on a 24-unit. And we'll be, well, we're actually still in negotiations, right? So we're still in talks right now with partners on that one. And I think it's a really key moment that this talk came up tonight, because I can really give you some in-depth, real information about what our challenges are actually right now with this deal, and from a JV standpoint. So this is kind of like a high level that I believe from my perspective is really what are the main differences between a JV and a syndication as a GP. So on a syndication, you typically will have an acquisition fee of anything from 2 to 3%. I've seen it up to 5%. That's definitely less common. If there's enough room in the deal, then all power to you to include that, because it is a lot of work that goes into these deals, no doubt about it. The JV side of things will typically have a lower to even 0% acquisition fee, really depending on the team. Again, it depends a lot on how good the deal is. Is there room for it? If it's tight and everyone's really equally putting in a lot of effort, then it really doesn't make sense to have an acquisition fee in there, because everyone's working hard towards it. And I'll talk about our most recent deal on that topic here in a moment. Higher closing costs for sure on the syndication. You'll be in the 4 to 5% range of purchase price, mainly because you're looking at additional attorney costs. So for the PPMs, the private placement memorandums that the syndication attorney has to do, those are lengthy and they cost a lot of money. On a JV, it's typically just an attorney on the front end looking at the purchase and sale agreement. Of course, always do that. Same as what you do on a syndication. However, then after that, they really are just drawing up an operating agreement. And on average, the JVs I've done, I would say fall between 2.2 and 2.5% of the purchase price. Caveat with that is my JVs are 24 units and less, right? So, if we're doing a larger JV, it's going to be a little bit more, I'm sure, but that's kind of my barometer. Percentage-wise, it's probably not going to be that much different. It's more time consuming for sure on a syndication. I've not seen many syndications close in less than 45 days, but you normally need more. You normally need 60 to 90 days, especially if you don't have a line of LPs already in place for investors. And there's just a lot more due diligence that goes into it, especially if, most syndications are, I'll come on to my criteria of why I would syndicate versus a JV in a moment, but there's always going to be more doors for the most part. So with that comes more due diligence, time requirement, because you're going to be working more units, looking through more information on the inspections, things of that nature. Now, assuming you have capital commitments with a joint venture, there's no reason why you couldn't actually close a JV when with less than probably a 3 million or less purchase price, depending on, of course, the power of your of your partner's capital, probably less than 30 days. So the one we're doing right now, we had 39 days to close it from when we got it in contract. So it's doable. Of course, a lot more closing paperwork on a syndication, maybe because of those PPMs and all the extra due diligence that goes with that. Investors typically want a shorter hold period on a syndication. Right now, it's quite common to see a 5-year hold, and there's been so much organic rent growth in many markets. We've been able to do a refinance event or even a sale actually in years 2 and 3. In fact, I've even seen some assets trade in 18 months. And all they've done is updated a couple of units and painted the outside and sealed and striped the parking lot, and it makes sense to exit. So, it's that's definitely an unusual, a very short period, and it's been really good for those that want to hold maybe less long. But on a JV, hold times are typically quite a lot longer. Now, I will underwrite it the same as I will at a syndication, but for me personally, I typically and the partners that I bring in the JVs, we all look at it as more of a longer term play, something that we'll want to hold maybe upwards of a decade, perhaps even longer than that, because for us, it's something that we can hold as more of a legacy property. It's going to provide cash flow, and it's something that potentially we can have in our family for a long time. You have more time in a syndication to raise the capital, so that's definitely a pro. It's easier to actually identify the returns, I feel like, in a syndication earlier on, because the sort of the deal structures that we're seeing right now are not that much. They're quite consistent. And what I mean by that is that typically you'll have like 80 to 20% equity splits, 80% to the limited partners, 20% to the GPs, and then there may or there may not be a pref, typically between 6 and 8%. However, with a JV, it's kind of a chicken and egg. You almost need to have the capital and your partner's commitments really early in the process, because for the most part, that's what the bank's going to need to actually begin the funding process. Whereas on a lot of syndications, especially if you're going agency, that's as long as the GP team can have got everything together, and you have a lot more time to do this, of course, then it's not such a rush. And to figure out what comes first is a lot more simple, I feel like, on a syndication. And I'll explain that a little bit more when I'm talking about our most recent deal. The bucket structure is more consistent as well. It's used fairly common in the syndication world. And I'll give you an example of what that looks like on the next slide. On the joint venture side, there's typically always more cash flow in my experience. The syndications, in my experience, so bear in mind, I'll caveat that I've done one syndication, right? And I'm going to come on to my personal experience with that in a moment. But for the most part, there is a capital event, an acquisition fee on the front end, and then you have the the exit, and then your GP percentage basically calculates how much of an acquisition fee you'll get, how much you get on the exit, and if there's a refi, of course, you'll get a percentage of that as well. But in my experience, the cash flow can be quite low, if not zero, in syndications. Unless it's a phenomenal deal and you've met the pref and you're exceeding it, then that's. But those, honestly, the type of deals I'm seeing right now, it's difficult to even meet the pref. Syndication wise, for the most part, they're going to be non-recourse loans if they're agency, and then joint ventures are recourse. So that, just to explain what that means, So non-recourse is where if in the event you're unable to make your loan payments on time and you end up, having to hand the property back, the bank is only going to basically foreclose on that particular asset. They're not going to come after you and your other assets you own, whereas recourse means that bank can actually come after some of the other assets you own, even completely outside of this particular property. So a little bit more risk, but as long as you get into it properly and you underwrite smart, then I have no issue with recourse whatsoever. So this is the bucket structure. So this is, like I said, more commonly used in a syndication to identify the GP equity splits. So you'll see there's 5 buckets here. And this is actually a screenshot taken from the SDA, the Syndicated Deal Analyzer. It's one of the more widely used syndication software tools used in multifamily. And you can use this for JVs too, actually. It's just, I'll use this bucket structure a lot more in syndications. And you'll see the top section there is split into, so you have the numbers in blue. So the 20% there, that basically is a ballpark figure for what the GPs will receive for sourcing the deal, due diligence, closing it. There's a good amount of work that goes into that for sure. You'll have then the second bucket will be risk capital. So people that put in money on the front end when there's potentially a risk you don't close and you could lose something, and that carries a good amount. And you can have multiple people do these roles. That's why you'll see there's 1 to 4, but you can even have more should you want to, and you just split that percentage between the partners. Money raising, that carries probably the biggest. So any GPs coming in with capital would carry 30%. And again, there's typically always multiple when we're obviously in that bucket. Balance sheet, so your KP, your key principal there. That's important. You need that liquidity and net worth. And then asset management. I feel like asset management should have a higher percentage, because as an asset manager, I think it's one of the hardest jobs in the business, and definitely I feel like it's sometimes overlooked on the percentage part. But you do have that fee as asset management fee sometimes as well, so that's in there. These are my basic rules of thumb, and again, this is my perspective, just in my experience from the deals that I have done. Now, well, the way I look at this, so if you have a deal, and bear in mind, I'm looking between 20 and 120 units. So I don't just look for deals that meet JV. I'll look for anything that works within that door count rise, plus some other metrics, of course, I look for. But if I come across a deal around the 4 million purchase price mark, that's about the limit in terms of purchase price, where I feel like, you know what, that's around $1 million for cash to close. That, depending on the amount of people in your network, so the partners you potentially have, let's just say you all have around 200 each, 250 perhaps, then yeah, you could totally take down a deal. And that's using around 4 to 5 GPs. Brings me on to my next point. I would not exceed 5 GP partners. It just makes the equity a little bit too slim. I'll explain why that is in a moment, but that's kind of my rule of thumb on the price. Now, obviously, if you have access to partners which maybe only 50 each, then your purchase price is going to be a little bit less, right? I would rather spend less, have less GPs, than spend more and bring in 10 GPs, because there's just not enough to go around when you end up doing it that way. The nice thing about syndication, and if you are questioning it, then you should be syndicating it honestly, because the amount that 80-20 or the 75-25 split in a syndication allows you to have that, all of that extra equity for those investors, and you haven't got to really be concerned so much about the amount of LPs you bring in. It doesn't affect your GP equity, whereas this does. So that's just my rule of thumb in terms of the amount. And honestly, everyone needs to be active as well. So just imagine having any more than 5 trying to be active in a deal. It's a lot going on, and there's not really enough roles anyway, I feel like, to fulfill more than 5 roles. So this next point is very important. So what are your core values and goals? So I'm not even talking about this maybe even like the particular property. When I talk about core values, you need to know the people that you're potentially going to be partnering with. So I'd encourage everybody to, go out and network, figure out like, who you drive with, it's, are you more family focused? Are you just like trying to really grow your net worth? Because that can really add a lot of extra strain on a relationship if you're quite different. And when I say different, I don't mean you need to be the same kind of person, because that actually won't work either. You're better off having, and that brings me on to the point there about having complementary skill sets, because each of you must have a role, but you don't really want to be too similar. So you need somebody that's, perhaps really analytical, that can be really strong with, going through the, perhaps you're doing market comps and you're working on the rent plan. Somebody that's maybe really good with contractors. So you're just having those complementary skill sets, super important. The operating agreement, the way that stipulates things is key as well. So you want to make sure, there's a lot more that goes into this, of course, but these are the high level points. Identify, with the buyout. So if somebody wants to leave the deal early, how does that look? Do you put it to a vote, or is there going to be do they need to, what would the amount be that you need to buy them out at? Or is your exit plan? Are you going to do like a per door valuation and then you'll discuss the option to exit and sell? CapEx costs. So right now we're looking at a deal and we're like, okay, well, doesn't make sense for everybody to be talking about, oh, we need to replace this this faucet in the bathroom or something, right? It just makes no sense. So let's put a limit, say per month of $5,000. And then, yes, we all need to come together and just agree that that's a fair cost. And, have we had enough bids or whatever the case may be? And then the whole period, that's super important. How long are you going to hold the property for, right? So that's where I'd say that's one of the more important ones, because everyone needs to be, you don't want somebody suddenly that's in the deal to say, oh, I didn't know we were going to be holding it past 5 years. I wouldn't have been in it otherwise, so that's key. Let's see. Now at the bottom point there, you'll see I've put a little asterisk. So I have heard it is possible, I have not personally done this, but I know that it is possible to bring multiple entities into one major entity and invest that as one GP. I have heard of that happening. I don't really know how that could be effective unless it's a really large deal and there's enough equity there to make sense. But I would think if one was to do that, the returns within that one entity would be so small, it just doesn't make any sense to do that. And that again would be one where I'd say just syndicate it. It's a bit, I would say that's kind of risky, but obviously seek legal guidance if you're considering that kind of approach. So this is an example. I'm going to have examples of all the properties I've done. This is the syndication that Ray and I did in 2019. So it was a 59 unit we purchased in July of 19 for 3.8. This is the structure we had. It was a 70-30, 70 to the LPs, 30 to the GPs with a 7% pref. 3.1% acquisition fee. We sold it last month for 6.6. Gave a nice tidy return to our investors of over 20% IRR and a 1 3/4 equity multiple. Spent around 600 in CapEx of the first 18 months. My perspective on, my returns in terms of the bucket structure for me on this deal. So I provided some risk capital, which got me 1% of that 30%. I helped find a deal and I did a lot on the front end of the due diligence. That got me 1.5% again of the 30. I also brought in some money. So that got me a 2%, had a little bit of balance sheet, which helped. And then the asset management piece as well was super busy on the front end. We had a lot of CapEx needs. So my total GP percentage was 12%. Highlights for me of this deal was that I got all of my risk capital back at closing. Now, had we not have closed, I'd have lost a good chunk, but I got everything back at closing. So that was great. I also received a percentage of the acquisition fee at closing based upon my GP percentage. I basically closed the deal. I had no money in the deal at that point. However, I didn't get any cash flow throughout the entire hold. We held for just over 2.5 years. But I knew there wasn't going to be any because, I was involved with the underwriting and that was just the structure. Now that's not to say that there may not be cash flow in other deals. It's just in my experience, there just wasn't room for it, especially with the pref. And then at the sale, obviously I received that 12% back of the gains. So that was it was definitely a good outcome on the front end and on the back end. Now this is my first JV deal I did in Fort Myers, Florida. Closed this last September. Really fortunate to find this on Loop now. Actually, it was a diamond in the rough. The photographs are really bad, and the agent that had it listed was really not experienced in multifamily. So I think he really undersold it. But yeah, we bought it from a mom and pop owner. He'd had it since 1980, and he lived on site. Basically, he was on-site manager, also maintenance, everything, one man band. Consequently, everything in the property was really up to date. Like he had new water heaters, new ACs, the roof's pretty new. He just painted it. We just did some minor aesthetic improvements on the outside, and the units, honestly, he had a lot of under market rents because he was quite honestly really friendly with his resident base, and he was almost nervous to even increase their rent. So I feel like if you're first name terms with your residents, then you're two in your business, and he definitely was. But yeah, so I paid $925 for this property, used a local community bank. The project returns 10% cash on cash on average over that 5-year hold, with over 20% average annual. I have 90% equity in this because I'm giving 10% to my construction manager. And then by the end of year 2, because we've increased our rents from about an average of, I think we were $825 when we took it on, we'll be over $1,200 by the end of August this year. And then we'll need a little bit of seasoning. And then depending on obviously where we are with interest rates, we're pretty confident we'll be able to refi about easily 70% out of that initial capital that I put in. Right, and that 25,000 a year cash flow is the project cash flows, not just mine, but that's still very, very strong. So yeah, that was quite different, I suppose, in comparisons to the syndication, but it's the way you structure it, right? This one was actually a deal I did with some partners I met through the Jake and Gino community. This was with a broker, Bo Beery, who's based up in Gainesville, and it's a 16 unit made up of 4 units, and we closed in December of last year. Looks a lot different now actually than it does in this photograph, but we paid 1.5 for it. I have 12% equity in that deal, and I was kind of bought into that deal because I just closed Fort Myers. The gentleman that was lead operator on this asked if I would be interested in coming in with it because I had the experience with a lender. I had some, I had a decent amount of net worth for this particular property, had the asset management, and obviously the experience on the loan helped as well. So that was the value that I was able to bring into the asset. And then we ended up using 2 other partners from the community that had 1031 money to deploy. So they bought in 400. And because of that service coverage ratio was below the 1.2, which most community banks look for, we had to go with a bridge lender. And yeah, we'll be exiting that bridge actually probably by the end of this year. But the project returns around 12% cash on cash and a 20% average annual. And I get about 6,000. That's at the end of year 1. That's not the project cash flow. That is my cash flow. So and that's my cash on cash as well. That 12. I'm sorry, not the project. So that's strong. The second deal I did with some partners was in Saraland, Alabama, just north of Mobile. 24 units purchased again in December, 2.1 million. I have 7% equity in this one, and actually the reason I was bought into this is because I haven't mentioned it here, but I had actually just done the other deal as a JV, and the prime operator was like, hey, I'd love for you to come in this deal. I'm really looking for some help on how to kind of structure like the operating agreement and the JV in general, because he was kind of brand new. And then he knew I had asset management experience as well. So, and then the other attributes from the previous deal were, also applied. So there was 5 of us in this one, and we all bought in a combined amount of 650. So you'll see all of these deals, the total amount coming in is way less than $1 million. And that's kind of what's, sort of fits my criteria for JVs. We had to go bridge on this one as well, because this photograph here, you'll see this was fully renovated. It used to look, it was red, it had mansard roofs, it looked nothing like it does in this photograph, but the guy ran out of money. All the units were done. The only thing he had left, I think, was just mirrors and fixtures and finishings in the kitchens and bathrooms, but he was completely wiped out, needed to exit. So we had to go bridge, because there was obviously no financials on that 16 unit, and there was an 8 unit just up the street that did have occupants. But fortunately, we've been really successful with getting residents in here, and we've only got 2 vacant units left. Just in 5 months, it's been phenomenal. I mean, there's a big shortage of brand new, effectively A-class, 2-bed units here in this town, but it's a really strong growing town with great schools. So it's been a home run. And yeah, my cash on cash on this is great, 18%, 22 average annual and IRR. And that'll be around 7,000 or so when we get it fully full in cash flow. Both of these deals, we're not planning on selling. Well, obviously we're both in bridge right now, and then we'll be exiting that by the end of this year to go into community bank, most likely, possibly agency actually on this one. And then we all agree we want to hold these long term, and that could be 10 years, it could be longer. So, but what we do have baked into the operating agreements is, a per door valuation. So in the event we get to a valuation of X, then it opens up the dialogue to discuss a sale. Doesn't mean we have to, but it just starts the conversation. And this is my most recent deal. So just got this under contract in East Tennessee about a week and a half ago now, and saw it this past weekend, just south of Knoxville. It's 24 units. Another LoopNet deal, actually. I was just fortunate to act very quickly when I saw it come on a Sunday night a couple of weeks ago, and was able to kind of leverage my bio of having a couple of units in the market, even though they were cabins, but having the strong kind of relationship with Bo Beery really helped, because this broker knows him really well, and it was advertised for 2.7. She was been really, really good to work with. We ended up getting in contract for 2.55, and total cash close is 700. Now the caveat with this one is he actually needs to sell absolute latest middle of next month. He has a 1031 requirement, and he needs that money by then. So that basically was like a 39-day from getting in contract. No community bank, unless you have an excellent relationship with them, is going to be able to fund that fast. Plus, there's the risk of the appraisal. So we've been able to find a local lender to work with us on this. And actually, they're quoting us, they should have all the paperwork done in 5 days from now. So we could potentially close this like 2 weeks early. However, this is what I was talking about earlier. We haven't got all the partners figured out yet. So even if we wanted to, we couldn't, because number one, we don't have all the capital. Number two, the lender's going to need basically the equity amounts from each partner. The attorney is going to need to know what those roles are within the operating agreement and what the equity is. So this is when I say, make sure you've got your partners aligned early, right? So luckily, we've got a pretty big network of interest, in both, because it's me and my one other partner, same partner that I'm in the Gainesville property with, have this deal, and we have a fairly wide net of people that are interested. And we've had some calls, and we feel pretty confident we'll have by probably late this week's hard commitments and most likely money in the bank. And at that point, we've already identified the equity splits with those parties, and we would have identified the roles, and then we can just kind of then, start moving forward with the OA and obviously the lender. But, if you don't have that stuff lined up, you could find yourself in a tough spot with something like this. So because it's a very short time frame, even more so. that was everything. So thank you so much for your attention. This is my contact information. If you ever want to reach out, happy to talk.
So we've got time for some questions for those that want to ask them. I've got one, Matt. I think other people kind of think through and can put something together on the question side. But so my question is, obviously the biggest difference between these two in a lot of cases, JV versus syndication, is the amount of money that you have to have on these deals, unless you have one JV partner that's putting in a much larger amount than everyone else. It does take a lot more money, but how do you make sure that everybody is active in the deal? What are the roles that you normally have when you are doing a JV, and is it any different than a syndication sponsor group would have?
Yeah, so I would say the way in which you can ensure, or at least attempt to ensure, everyone remains active in the deal is have that stipulated in the operating agreement. So, for example, our Sauerland deal, we have a clause in there. If any party basically is not fulfilling their requirements of their role, then there is basically they potentially risk losing their a portion of their equity, if not all of it. So there'll be a meeting, right, to discuss what's happening, what are you having some problems that we're not aware of, just talk to us, what's going on. And then if you continue to see similar behavior, then that's when we would need to kind of leverage what's in the OA and potentially have to buy them out. That would be, fortunately that hasn't happened in any of the deals I've been in. And another nice thing about sort of the smaller deals, and also being smart about what deals you buy, once you've got through the, say, first 6-12 months, the amount of work that goes into these deals is actually fairly manageable. Not to say you don't know everyone's working, but you could basically have somebody, let's just say you've got someone that's got a lot, a good amount of capital that they want to deploy, but maybe they have the least amount of experience, right? And they're like, I'm not really sure like how I can add value to this deal. So I really want to be involved. I want to learn, right? And that's great. Well, my advice, the conversations I've had with folks that are in that position is like, well, it's super important, I would say, especially right now with the rent growth we're seeing, is mystery shopping. So let's put you down as, every quarter, you're going to be calling PMs, screeningapartments.com, Zillow, Trilio, Hotpads, and basically secret shopping to see, okay, are we as competitive as we should be on our rents? And if we're not, what amenities do we need to do to basically get caught back up? Or, is there some other things we're missing in terms of other income items? Should we be perhaps moving towards doing move-in fees, moving away from security deposits, things of that nature, or perhaps, starting to incorporate pets, or, maybe we didn't, this particular deal in Seymour, we're actually going to be charging water back because the current owner's not. But, checking other markets to see if indeed those other properties are including water, or are they not, just making sure that we're just remaining competitive in the market. So that I feel like anyone can do that. Another role that somebody could do, especially on something that needs, some renovations or aesthetic improvements, is see, okay, well, perhaps they're really good with design. So you could put them in charge of, color schemes, right? So, okay, well, this is what I think we should be working on for our next round of turns, right? So we want to do agreeable gray with, white trim, gray vinyl plank, or whatever it is, and then have them kind of work on that and, put that together. And also what we do in our JVs is we use Asana, which is a project management tool. There's other ones called Monday and things like that. They're very similar. That way, everybody has actually an identified function. So you can actually identify tasks within there and say, okay, we need this done by this date. I'm assigning you as that manager for that project. And they can actually respond within the tool, and that way everyone's got visibility. And we even include our PMs on Asana as well, so that they're made aware of what we're working on. And if they have questions or anything, they can just go in there and see what we're doing.
Great. I saw there were some questions. Jose, if you want to jump on and ask your questions.
All right. Yeah, great presentation, Matt. Congratulations on all your success.
Oh, thanks so much.
Yeah, I was diligently taking some notes here because you had some very interesting bits here. So the first one is you mentioned for JVs, non-recourse loans versus recourse, obviously, for syndications. Can you elaborate on that?
Yeah, of course. Yeah, so with, now this is assuming you're going to be smaller deals. So a smaller deal in a JV, you know, like I mentioned, is going to be a total cash close of around $1 million. That may most likely be a community bank, right? That's at least all the ones that I've experienced would normally fall into that category, because agency, so Fannie Freddie is going to require you to have at least $1 million loan amount.
Yep. Okay. I follow you. I totally understand. I thought there was a different reason for that, but I understand it's based on the loan amount.
It's all based upon the type of debt you're going to put on it. Yep. Now, if there's no reason you could totally go agency with a JV. That's absolutely fine. It's then it really depends on the amount of liquidity you have around you.
Got it. Yeah. All right. Good deal. I think for the Tampa deal, if I recall, you mentioned a 7% pref, but there was no cash flow. Was there a deficiency at any point in time during the whole period?
Well, there was cash flow to the LPs. It just there wasn't cash flow to the GPs, and yes, there was, because we obviously had COVID less than a year after takeover. So yeah, we definitely had some bumps in the road because of that. So yeah, we had to hold distributions just for a short period as a result.
Okay, and that's kind of where I was getting. I'm always curious to find out, like, how do you deal with situations like that and investors?
Be upfront, you know, explain to them, get them on a call, say, hey, this is where we're at. You know, we've received letters from these residents. They're not able to pay right now. You know, luckily we've got, you know, these reserves in place to be able to allow us to continue operating. The property managers have been informing the residents, you know, how to gain additional support. You know, just be completely transparent. You know, they're going to appreciate that.
Excellent. Let's see. The other question I had was, what kind of terms do you typically get for the bridge loans? I noticed for some of the properties you had to take out a bridge loan.
Yeah, 3 of them, in fact. So the 2 we did in December, we got great terms. In fact, they're all probably arguably as good a terms on those than we're getting on community right now, because the rates were better than they are now. But we got a 80% loan to cost with a 5.5% interest, 100% of the renovations covered. I think it was a 2-year term with a 1-year extension option for 1 point, no prepayment penalty, 2% origination fee. So yeah, pretty good terms. The one we're doing now is an 8.5% rate, 18 months term. Again, no prepay. Actually, a lot of them are actually charging exit fees. This one isn't, but we did find that a lot actually. Right now, there's quite a few exit fees, and again, they're covering 100% of the renovation, but not that we don't really need too much of that because this is a newer property. But yeah, shop around for sure. There's some variation out there still.
Great. With regards to like finding PMs for some of these smaller properties, because every now and then I'll run across some of them, and you know there may be like an 8 or a 12 unit, and it's like, you know, finding a PM that may be interested in managing that, I feel like could be a challenge. But has that been difficult for you and your team to find PMs for the smaller properties?
So a lot of that's going to depend on your market, right? So for an example, my Clearwater property, I had a hard time picking one because there were so many good ones. There's also a lot of bad ones, of course, but there was about 3 that just really were great. And that was good because that's because Clearwater is in Tampa Bay and there's a tremendous amount of properties there and lots of property managers. Sandland, Alabama, not so much. There's, I think, 2 PMs in the entire town. And the rest of them are down in Mobile, which you know is not that far, but again, there's a limited amount of them down there, so it's going to be very market specific. But there is actually I can share actually a list of questions I ask my PMs if that would be helpful to allow you to kind of screen them.
Sure, absolutely. Yeah, I think I have something like that from like Joe Furless, but I'm always willing to learn more. So
Yeah, I mean, I could fill an hour with telling you how to screen a PM. So I'll send that to Ray so he can forward it out.
Yeah, and on the recording, I'll post it on the YouTube so you guys get that link. So I got a question from Vessi. I don't know if she had her hand up, so I want to give her an opportunity.
Thank you, Ray, and wonderful presentation, Matthew. Very detailed and very thorough. So thank you for that.
Thanks so much.
I have a quick question. When structuring JVs, does your cash contribution always equal the ownership share? Or in other words, how do you ensure everyone's appropriately compensated for any additional sweat equity they may bring to the deal?
Yeah, good question. So now there is, so in the software I use, I don't use the SDA for most of my JVs these days. I use a different tool, but that does have the ability to put in the amount of capital you're putting into the deal, and it's going to tell you, okay, this is the amount of equity you basically would get if it was apples to apples and everyone was just doing the exact same role, right? However, that's never the case. So you would just use that as a guideline. I would say it's you're going to. Do you remember the bucket structure I shared at the beginning?
Yes, I remember. Yep.
Yeah, so I would use that as a basis to say, okay, well, who found the deal, right? So in fact, if I go back to that, it'll be probably be easier to explain. So on this top one here, so who found the deal? I mean, that's going to be maybe one or two partners. It's unlikely everybody found it together. All right, so that's quite easy to identify, and you could use a similar percentage of GP towards that bucket. And then risk capital, same thing. It's unlikely everybody is putting in risk capital. It's probably only one or two people. And then the raise is ambiguous because you're not raising, it's everyone's bringing in their own capital. So that really should be kind of split equally. But obviously dependent on the amount you're putting in, right? And then balance sheet, yeah, you could use that because you are going to need, X liquidity, and perhaps who's ever carrying the most should be getting more on that bucket. And then asset management. So in Starland, we all pretty much talk asset management every week. We have a weekly cadence meeting. That's just because we're still kind of fairly new into the deal and we're still filling it. But once we got it completely filled, we'll probably back that off to maybe monthly. But that's going to really depend on what those roles look like, because if you've got 5 asset managers, that's probably a little bit too many. So I would probably want to maybe cap that at 2, maximum 3 asset managers. And then you have, say, if you had 5 total, you're going to probably have a couple people that won't have that 15% factored in.
Thank you.
Sure.
And I believe I saw somewhere on the slides you mentioned some of the JV members, LLCs may actually have, those LLCs may have 2 or 3 members each, or a couple members
Yes,
each.
that's right.
Sure. Oh, that's the one. Wasn't sure if what your experience has been with that, and if there's a certain cap one should consider within those respective LLC.
Yeah, I mean, so the attorney we're using for our Tennessee property, I know she is quite experienced in that kind of structure. So this is something I should have mentioned. I would definitely encourage you to find an attorney that has done a number of JVs, because if you go to say a syndication attorney and perhaps they have not done JVs, it wouldn't be that likely because most of them have, but it's possible. They're going to really struggle. The attorneys that I've used, and I've only used 2, depending on what market I'm in, they have done a number of them. They're very experienced in it. They're going to be able to give you a lot of guidance. They also have basically almost like a kind of a template that they go by, and a questionnaire, right? That they send you to identify, okay, well, what's the main way in which you're structuring this deal? And that allows them to kind of, really dial in what the operating agreement should be looking like.
Thank you.
Sure.
Debbie's got a question. Debbie?
Yes, hi. Actually, this is Debbie's husband, Keone.
Hey, Keone.
Hi. I had a question about a couple things. Yeah, you just briefly touched on it. The bucket for capital raising bucket in a joint venture. I don't quite. I mean, shouldn't that bucket just be removed and it should become
Yeah.
part of 80/20?
Pretty much, yeah. That's why I said it's kind of ambiguous. It's, you know, it's not really, that's kind of one of the main reasons you may not even use this bucket structure in a JV. But yeah, I mean, everybody's obviously bringing, well, in theory, most people are bringing in, you know, capital potentially into a JV. So yeah, but obviously some could be bringing in more than others, but you shouldn't necessarily be always factoring in the amount of equity someone's getting because of the money. But, you know, ultimately that does, obviously, if someone's putting in a significant amount, of course they're going to want, you know, some more equity for that. So it's important, but it's also not. It really depends on the deal.
Yeah, I think a better way to categorize that is capital contribution, and then just change a percentage if it makes sense to make it a little bit more or less.
So what if I like brought in another partner, you know, to the deal? That wouldn't be like I would get a percentage for bringing another partner in with money. No, just
No.
what I bring. It's just what I bring in, right?
I mean, if you want to have that conversation with that partner and say, hey, I'm bringing you in, but I'm going to, you know, I'm going to basically perhaps have a little bit more for bringing you in. That's potentially okay. I have heard of that happening, but that doesn't, that's kind of rare.
Yeah.
So
right. That
yeah.
doesn't seem fair to me, but
yeah.
And what about also like some JVs, like they'll have an acquisition fee or an asset management fee. Is that normal or is that just for a syndication?
Yeah, I mean, I covered that a little bit here. So I've actually come across a number of JVs that have got acquisition fees in them.
Right.
I think if there's room in the deal and the people on the front end, perhaps if you've got like, so this deal that I'm working on right now, you know, we're doing a tremendous amount of work on the front end, and the partners we're bringing in are going to be more kind of involved post close, right? Okay. So, you know, that's kind of a, you know, that's something that really, if the deal can allow for that, should be compensated for, in my opinion. So if you've all kind of working together and you've all got the deal together, then for the most part, an acquisition fee wouldn't make sense.
Okay, that makes sense.
Yeah.
All right. Thanks, Matt.
Sure. Thanks for the questions.
Yeah.
Any other questions? All right. Well, I think we'll give another 2 seconds. You killed it, Matt. You killed it, man. I appreciate it. I tell you, I've tried doing JVs. At the end of the day, it's I still look for JVs. It's they're good opportunities. You do need to have a little bit more cash, I think is probably the biggest drawback. So if you're newer, you may want to go with that. You know, you can get into a syndication if it's a 506B. And you wait towards the tail end of the deal. If the 50K in, you may be able to get in for less than that. You know, you can get in for, I've gotten on some where it was 25K early on because it was they were just about done. So I think that's going to be one of the big discriminators between getting into a JV and not is how much capital do you have? Because it's, especially in Florida, it's kind of hard to find, you know, anything, even a single family where you can come in with 25K, right? You got to come in 50, 100. 200. And so I think that's the value on the syndication. But you're right. I mean, there are ways that you can certainly make more on a JV because you own more. The question is do you have the property management that's going to get you to that promised land? Smaller deal, how much do they charge? So there's a lot of other factors. But if you can kind of underwrite it, it's a good opportunity either way. I mean, certainly better than single family. A single family is just you're one occupant away from no income.
Yeah, I will say so those two deals we did in December, my capital contribution was pretty low actually, but what I was bringing to those deals was experience and net worth, and I was able to, I had the relationships with the lenders, right? So that added a lot of value to those operators. So I think if you build those relationships and you can add value in a different capacity than just capital, then you actually totally could get into a JV. But it's, you know, it's all about, you know, networking and finding people that want to work with you and vice versa.
Yeah, that's true. You can definitely find somebody that brings the majority of the cash and you do the majority of the work. I mean, those
Mhm.
things do happen as well. But I think you're right. I think you have to have a lot of experience and you have to have done it for people to want to trust you that way. But no,
Exactly.
it's a good point. Networking is the most important thing. So I will give you the rest of the evening. Enjoy your night. Invest where it makes sense.